In a move that has sent shockwaves through global markets, Japan, long seen as a steadfast ally of the United States, has taken a bold step in retaliation against U.S. trade policies. The country has begun selling off its vast holdings of U.S. Treasury bonds, a move that could have significant implications for the U.S. economy. This financial counteroffensive comes as the two economic giants are locked in a trade war, with the U.S. imposing hefty tariffs on Japanese auto imports. Japan's actions are a clear signal that it is willing to use its economic leverage to defend its interests, even if it means challenging the U.S. on the global stage. The escalating trade tensions between the U.S. and Japan are a cause for concern for the global economy. Japan, the world's third-largest economy, has long been a champion of free trade. However, the U.S. protectionist policies under the Trump administration have forced Japan to reconsider its approach. The current trade war, primarily focused on the auto industry, has seen the U.S. impose tariffs of up to 25% on Japanese car imports. This has put significant pressure on Japanese automakers, who rely heavily on the U.S. market. The U.S. argues that the tariffs are necessary to protect American jobs and reduce the trade deficit with Japan. However, critics argue that the tariffs are counterproductive and will ultimately harm the U.S. economy. They point out that the tariffs will raise prices for American consumers and make U.S. companies less competitive globally. Furthermore, they argue that the tariffs are likely to provoke retaliation from Japan and other trading partners, leading to a downward spiral in global trade. Japan's decision to sell off U.S. Treasury bonds is a calculated move designed to send a message to Washington. As the second-largest foreign holder of U.S. debt, Japan has significant leverage over U.S. interest rates. By selling off its holdings, Japan can drive up borrowing costs for the U.S. government, potentially slowing down the U.S. economy. While the immediate impact of Japan's actions may be limited, sustained selling of U.S. debt could have a more significant impact on the U.S. economy. The ongoing trade dispute between the United States and Japan represents a new front in the global trade war that has been simmering for the past few years. While the Trump administration has primarily focused its protectionist policies on China, the U.S.-Japan trade war highlights the administration's willingness to target even its closest allies in pursuit of its America First agenda. The auto industry, a cornerstone of both the U.S. and Japanese economies, has become the primary battleground in this trade conflict. At the heart of the dispute is the U.S. substantial trade deficit with Japan, particularly in the automotive sector. The U.S. has long argued that Japanese automakers benefit from unfair trade practices, such as currency manipulation and non-tariff barriers, giving them an advantage in the U.S. market. The Trump administration has repeatedly called for Japan to open up its markets to more American-made cars and reduce the trade imbalance. In response to what it perceives as unfair trade practices, the U.S. has imposed a 25% tariff on Japanese auto parts and a 2.5% tariff on finished vehicles. These tariffs have significantly increased the cost of Japanese cars in the U.S., making them less competitive against American and other foreign-made vehicles. As a result, Japanese automakers have experienced a decline in sales in the U.S., one of their most important export markets. The U.S. tariffs have had a ripple effect throughout the global auto industry, disrupting supply chains and creating uncertainty for businesses. Japanese automakers facing higher costs and declining sales in the U.S. have been forced to adjust their production plans and investment strategies. The tariffs have also raised concerns among American businesses that rely on Japanese auto parts, as the increased costs are likely to be passed down the supply chain, potentially leading to higher prices for consumers. The U.S. tariffs on Japanese auto imports have delivered a significant blow to Japanese automakers, who are grappling with declining sales, shrinking profits, and a loss of competitiveness in the U.S. market. The tariffs, which have increased the cost of Japanese cars for American consumers, have made it more difficult for Japanese automakers to compete with their American counterparts and other foreign rivals. This has led to a decline in market share for Japanese brands and forced them to reconsider their strategies in the U.S. The impact of the tariffs on Japanese automakers is evident in their financial performance. Toyota, Honda, and Nissan, Japan's largest automakers, have all reported declining profits in recent quarters, citing the U.S. tariffs as a major contributing factor. The tariffs have forced these companies to absorb some of the increased costs, cutting into their profit margins. In some cases they have also had to raise prices, making their cars less attractive to price-sensitive American consumers. The tariffs have also disrupted the carefully calibrated supply chains that Japanese automakers have built over decades. Many Japanese automakers have manufacturing facilities in the U.S. that rely on parts imported from Japan. The tariffs have increased the cost of these parts, making it more expensive to produce cars in the U.S. This has led some Japanese automakers to reconsider their investments in U.S. production, potentially jeopardizing American jobs. The U.S. tariffs have created a challenging environment for Japanese automakers, forcing them to adapt to a new reality. In response to the tariffs, Japanese automakers have explored various options, including shifting production to other countries, increasing prices, and absorbing some of the increased costs themselves. However, these measures have come at a cost, impacting their profitability and competitiveness. The tariffs have underscored the importance of the U.S. market for Japanese automakers, while also highlighting the vulnerabilities of relying too heavily on a single market. As Japan navigates the turbulent waters of international trade and economic policy, the long-term impacts of its strategies are becoming a focal point for global analysts. Experts forecast a range of potential scenarios that could reshape not only the Japanese economy but also the broader global market. Gap 2S. One possible scenario involves Japan doubling down on its investments in technology and innovation. By leveraging its strengths in sectors like robotics, biotechnology, and renewable energy, Japan could carve out new niches in the global economy. This shift could reduce its dependence on traditional manufacturing exports, thus mitigating the impact of trade barriers. Gap 2S. However, the road ahead is fraught with challenges. Japan's aging population and shrinking workforce pose significant hurdles to sustained economic growth. To counteract these demographic trends, the country may need to implement more aggressive immigration policies and invest heavily in automation technologies. Such moves could have far-reaching implications, potentially setting new standards for how advanced economies handle similar issues. Gap 2S. On the flip side, some experts caution that Japan's economic strategies might exacerbate existing tensions with key trading partners, particularly the United States. If Japan continues to pursue policies that are perceived as protectionist, it could trigger retaliatory measures, leading to a further escalation in trade conflicts. This scenario could disrupt global supply chains and create economic uncertainty on a scale not seen since the financial crisis of 2008. Gap 2S. Despite these risks, there are also opportunities for collaboration and mutual benefit. Japan's emphasis on sustainability and green technologies could align with global efforts to combat climate change, fostering partnerships with countries and corporations committed to a sustainable future. Such collaborations could pave the way for new economic models that prioritize environmental stewardship alongside economic growth. Gap 2S. Ultimately, the long-term impacts of Japan's economic strategies will depend on a complex interplay of domestic policies, international relations, and global market dynamics. As the world watches closely, one thing is certain. Japan's financial moves will continue to send ripples through the global economy, influencing trends, shaping policies, and redefining this evolving landscape. Staying informed and adaptable will be crucial for businesses, policymakers, and consumers alike. The future is uncertain, but understanding the potential trajectories of Japan's economic strategies can provide valuable insights into the forces that will shape the global market in the coming decades.